Is Chipotle stock CMG overdone, overcooked, ready for a reset? Well, the stock is up over 300% in the last 5 years. So it's done quite well, even though it is down over 5% today. Yet when I look at the fundamentals, and this is a new sheet available at AI Ticker Chat, where you can do a comps analysis of Chipotle versus, some relevant fast service restaurants. And you can see it has a similar market cap, around $90 billion to Starbucks, despite the fact that it has only a third of the sales, less than a third of the sales, 10 billion versus 36 billion, and a fraction of the free cash flow, setting a much higher multiple, 50 to 60 times, versus slower growing businesses like McDonald's and Starbucks, which are closer to 20 to 25 times. So 50, 60 times versus 20, 25 times, for Chipotle. So clearly people are Wall Street is giving Chipotle a premium. The question is it justified? When you look at their most recent earnings, I could understand the case because they're posting 14% total revenue growth, which is driven by their existing store base, the comparable restaurant sales increasing by 7%, profit margins expanding from 15% to 16%, and then earnings growing a whopping, maybe I shouldn't say whopping, that's the Whopper Burger King. Maybe I should say a grande, heavy duty earnings increase from 1050 to 13. Holy moly, 27% increase. So holy guacamole, maybe that's even better. And so, they're posting amazing earnings growth. So, and not only is you're seeing this earnings growth, it's not only due to this revenue. Doo-doo's is what's going to happen if you eat too many burritos. You're saying, sorry for all the jokes. So you see 7% increase in comparable restaurant sales, and it's partly driven by this higher transactions. So you're seeing more traffic, more people buying, as well as an increase, a 1.6 increase in average check. And so that means people are either spending more, they're buying more stuff, such as getting a drink with their food. And they're also talking about around 37% digital sales, which means that they're tapping into the new economy, meaning maybe people feel comfortable ordering it online. It's not just card at present, types of transactions. You're doing it online as well. Looking at their potential in the years ahead, particularly diving into their latest quarter and transcript, management's talking about, look, yes, they have around 3,400 restaurants throughout the United States and around 68 internationally, which does reflect that internationally, really, they haven't pushed it. They're working on the concepts, and they talked about this on the call about how they're pleased with the progress with Canada and pleased with the progress with Europe, but it's still early days, and effectively it's they're experimenting, and they opened up one of the first ones in the Middle East, and so they're I think it was Kuwait, and so they're it's clearly very, very early, and maybe that's some sort of option for the growth of the business over time. But the United States, North America, that's where it's at least for now. And management's saying, look, they think they can get to 7,000 locations in North America versus the 3,400 currently, which would suggest more than doubling the business over time. They are talking about opening up around 300 per year, so that really does help with their growth trajectory. When you can pencil out the couple hundred each year, in addition to same store sales being positive. So that does help the thesis being justified that they're still early on with the rollout, whereas something like Starbucks, it's on, sometimes you have multiple Starbucks, on one street corner or on one block. And so looking at Wall Street estimates, you could see sales are effectively expected to double over the next just couple of years. Earnings are expected to also more than double over the next few years. So maybe this is how you're getting the Wall Street justification, saying, well, trading around 30 times 2027 earnings, maybe that's not bad because of how likely it is for them to deliver teens growth year after year after year. Because, once again, management's saying, they can open up 300 per year. Their goal is 7,000. They're at 3,400. So you see this doubling of the store base. You get another 5-7% in terms of being a layer on comp store sales. So then you can get that, steady growth. And then the question is, are you able to get the kicker here, which really drives their profits, which is expanding profit margins? And we'll talk about that towards the end of this video. Another aspect that I think investors got excited about recently, which honestly, it's just like maybe I was originally going to talk about slicing a pizza into more slices, but maybe it's more appropriate to talk about slicing a burrito, where you're not really slicing a salad. You toss a salad. So looking at there's a 50-for-1 stock split. And so you get a lot of retail investors like, woohoo, I'm going to be getting all these additional shares. Like, hold your horses. Like, you're just cutting the pie up into more pieces, slicing the burrito into more pieces. The burrito is not getting any bigger. And so that's expected to happen later this month. I'm not a fan of how management's like calling, this is one of the biggest stock splits in New York Stock Exchange history. Holy guacamole. I'm not impressed, to be honest. Splitting a burrito into more pieces does not create more value ever. It doesn't. I mean, maybe if you have a different scenario where maybe you're sharing it with your friends or something, it doesn't. Splitting it up, having a stock split 50-for-1 doesn't really shouldn't increase the market cap. Sometimes you get retail and traders say, oh, well, once the market cap there's more retail, it's going to cause it to pump up. I think it's worthwhile to ignore that sort of things. Just as Charlie Munger might say, just pretend it doesn't happen. So where does Chipotle go from here? First of all, in full disclosure, this is not financial advice. Also, quick plug, just yesterday on our exclusive Discord server, a member wrote, this is a direct quote, "First of all, I would like to thank you for all the knowledge that you share with us. You have helped me a lot in my investing journey. I've managed to turn £3,000 to £500,000 in 4 years with a regular salary." And honestly, that is the type of story that I absolutely love to hear. We're sharing my letter and video on a monthly basis. Exclusive video for my subscribers is helping empower members of the Unrivaled Nation to help achieve their own financial goals. So if you're interested in compelling investment ideas or, what I'm personally sharing on my own investment journey, come check out unrivaledinvesting.com. That story really made my day, made my week. I absolutely love to hear that. So thinking about Chipotle, I think I broadly have three concerns. Looking at it, first is sort of the macro high level, which is that there have been some recent data points suggesting that the U.S. consumer is weakening significantly. I think, it's important to recognize macro is one aspect to investing. Some people can absolutely ignore it. Over time, personally, I think it's important to say, okay, there's a lot of noise with it, but I think it's good to be aware. And so the recent macro data on consumer spending does suggest it's gotten weaker. And then overlaid with just asinine policies like raising the minimum wage, there's other intelligent ways to help the underdog. Warren Buffett has talked about at length how raising the minimum wage isn't the right approach. Tax credits is a much more efficient way. But raising the minimum wage to $20 in California, a major state for Chipotle, is resulting in them having to raise their menu prices by 6-7%. And, the expectation is, okay, well, you're just sort of, it neutralizes. But the reality is consumers sometimes go, oh man, 6-7%. And then it results in spending less because, the price point just becomes so much that they go, I'll just buy myself a can of beans versus spend the $15 for my burrito. So this is a dynamic for investors to consider. The first is the macro. The second, this awful picture, is the valuation, suggesting that Chipotle, around $3,200 per share, that's before the 50-for-1 split, that's expensive. It's a very full valuation, 56 times forward earnings. So this is, the stock is as full as this guy who's eaten a lot of Chipotle. And not surprising to look at, the range of possibilities. This is using the AI Predict tool. It really does reflect that even if you have record sales continue into the years ahead, growing somewhere between 6 and 11% per year, and you have, let's say, profit margin expansion from 16% to 18%, if you have any sort of multiple compression from, let's say, 50 times, 56 times to 35 times in the next 5 years, then you could have a very mediocre or lousy return. And that's what this base and low case scenario sort of reflect, which is where you don't have significant margin expansion or you have valuation compression, what your returns could be like. That said, if you have, margin expansion and fantastic growth and the multiple doesn't compress too much, stays at 45 times in 2028, then you could have less than 100% upside. And that's my concern thinking about Chipotle, is putting the pieces together, is even with amazing execution that you see in this bull scenario, it's just still not enough to justify a great return in the years ahead. And that's why I think Chipotle stock is overdone, at least in the medium term. I think long term the thesis still plays out, but I think you're going to have a little bit of indigestion. And so thinking about, this is a third concern, but maybe this is the opportunity. And so let's actually talk about this for a second, because this is worthwhile for investors to reflect on. This doesn't just apply to Chipotle, but Chipotle is a great example. So Chipotle investors are Wall Street. That's what these light green bars are, is Wall Street expectations of operating margins in the years ahead. They're expecting record margins in the years ahead. Now, that is a concern to me, especially when I look at, how things have done over time. If anything, if you think there's some sort of reversion to the mean, you might say, well, maybe they're over-earning, and, this could result in Wall Street saying, earnings are actually going to be a lot worse because margins aren't going to be 20% in the next few years. Maybe it goes back to, 12 to 16% in the years ahead. That's a real risk, that it's sort of over-earning. But I think it's also an opportunity. And this is why, because at the end of last year, they talked about how they were teaming up with Hyphen to begin testing new digital make line, which is, this is where you're talking about automating the production of goods. And so this was October. Hyphen is the company, where they talk about automating kitchen operations. Bowls and salads are created by an automated system that moves the entrees through the bottom make line, where ingredients for the orders are dispensed automatically. And the reason why this is important is 65% of all Chipotle digital orders are bowls or salads. So you could have this running, in theory, to help the physical labor, which represents around 24-25% of Chipotle's expenses. So could you have a situation, and this is the broader question that I want to raise to you, could you have the robotic revolution start to show up at a Chipotle near you, where, the businesses start leveraging the automation? Maybe it starts with digital orders, then it starts moving into when it's peak rush hour traffic. Can you start to see a labor element, especially when you have to pay labor $20 an hour in some states? Could you start to see a dynamic where Chipotle actually exceeds that 20% margin framework that I was just laying out, because they're increasingly automating labor away? And so I think that is a real opportunity for Chipotle, risk to society in terms of entry-level jobs and employment in the next few years, that I think we could see play out. Now, keep in mind, this headline, from Chipotle was at the end of October of last year, or the beginning of October last year. And so it is worthwhile to call out, I would like to see an update on that. It's very possible that it's just not going to expectations. That's why we're not seeing more updates. But I think that is a real option for Chipotle to significantly exceed Wall Street estimates, is if they're able to find out a new hybrid model. And I'm glad to see management experimenting with this, where they could say, hey, maybe we can get labor to 20% because more of it's automated. So I'm very curious to see how that plays out in the years ahead. I think the broader bull thesis, when the management talks about 7,000 locations, I think that's a structural tailwind for this business over time, because they've probably scouted out locations where they go, okay, this is probably the next source for 2025 and 2026 and when we're going to get those leases. So I think that growth is there. The question is, can you get a second kicker from the margin expansion, potentially from dealing with automation? We will see how that plays out. You do have short-term risks. So I'd say the bull long-term thesis is likely there. In the medium term, 3 to 5 years, you will have valuation issues. And that valuation can be a headache, making investor returns, give you indigestion, making an unpleasant, bumpy return. But longer term, thinking beyond 3 to 5 years, I think you do have that benefit of both margin and growth. And so I hope this video talking about Chipotle, the near term, the long term, what's going on with the business, has been helpful for you. If so, please make a point of hitting that thumbs up, hit that subscribe button. Thanks so much for watching Unrivaled Investing.